Hello and welcome, and thank you for joining me. My name is Joel Keylor. I'm the CEO of Tresle. Today, we're here to present part two of our frequently most asked questions as it relates to selling a small to medium-sized private company. After the outpouring support that we received after part one, we realized that there's just many other questions out there that prospective sellers have. And while, of course, we can't answer everything, we thought we'd dig in a little bit deeper to the common questions that were received that we didn't cover in the first video. If you haven't had a chance to watch the first video, please check it out. We will link it in the show notes below. Our mission at Trestle is simple. It's to enable small to medium-sized businesses to change hands, and doing so by offering a convenient and accessible and elegant platform that bridges buyers and sellers. And if we can educate people in the process, the more, the better. So with that, let's get right into the presentation. So we get this question a lot: is now a good time to sell? So I want to touch a little bit on the concept of timing because it can be seductive, but ultimately it's fool's gold. Some sellers think, or business owners think, that they can maybe pull one over on a buyer, and some do. They try and think that they can sell at the top of the roller coaster within their industry. I really caution against this way of thinking. As it relates to timing, I always like to think of it like similar to public market investing. So after all, if you know anything about the stock market, you know it's very challenging, if not impossible, to time the market. People often confuse complexity and sophistication with performance. However, we know that most investment firms, most advanced systems still often underperform just the market. So, when everybody is telling you what they know what's going to happen next, frankly, nobody knows. Take it from the greatest investor of our era, Warren Buffett, who said, "I haven't the faintest idea what the stock market's going to do in the next 6 months or the next year or the next two." And the truth is, none of us do. So on this screen, you'll see we've kind of highlighted two examples. So on the left, we have the entertainment industry, so to speak, from a stock market perspective. So we have two stocks. We have Netflix and Cinemark, so theaters. And so as you can see, nobody can predict the future. You look at the line, the vertical line, that shows around March of 2020. We all know what happened then, but as you can see, just that small change in being able to be close to another person drastically affected, and something that was not really in anybody's model early 2020, that drastically separated the stock market. And you can see really a line in the sand for that differentiation. Same goes in the fitness industry. If you look on the right hand table, we're looking from a revenue perspective, two stocks of Peloton and then in-person Planet Fitness gyms. Again, kind of the same story. So the lesson here is that there's too many moving parts and so much information and analysis out there to get any true edge. Just ask anybody who bought a restaurant in early 2020. The point is, spotting peaks and valleys is frankly a waste of time. It's just as tough as time in the stock market. So forget about that. For your purposes, you just need to know the status of the company, which we'll touch on before, and which we'll touch on later on, and whether you are ready to move on. The rest, it's a fool's game. What do I need to do before I take my business to market? So, like most decisions, the decision to sell your business is complicated. I've never heard of a business owner waking up one day and having this epiphany of, I'm going to sell my business and then acting on it right away. Rather, we find that it's a little bit more of an ongoing process of discovery, and it involves several different stages. For this question, I think it's easiest to break it down into two sections: you and your business. So let's start with you. There are many reasons why you might decide to exit your business. Maybe you're in search of a new opportunity. Perhaps you no longer have the time and energy to devote to the business. You've realized you're no longer the right person to take that company to the next level. Yeah, or maybe there are a plethora of personal or external reasons motivating your sale, like your health. Whatever the reason, it's essential that you are ready for your next step. You've worked hard, spent years creating your business. As the owner, you st- you need to spend time prior to going to market self-reflecting. Are you comfortable handing the reins to somebody else? Will you ever be comfortable with this? Will you have any remorse once you exit your business? Do you know what's next for you on the horizon? What's an ideal timeline for the transaction? What are your top non-financial goals? How long are you willing to stay on the company post-close? What are the range? What is the range you'd like as a financial result? What are the characteristics you'd like in your ideal buyer? And really, only you can honestly answer these questions. And it's important to spend some time self-reflecting on, what an exit looks like for you. In the end, you must be fully committed to the process in order to avoid disaster. And we'll touch on this a little bit later on as well. So now let's look at your business, the other side of it. So the easiest way to understand this is simply by putting yourself in the buyer's shoes. In other words, if you were assessing a possible investment, what would you look for? What is reasonable? And once this is understood, we can really work backwards to understanding the preparation in terms of documentation. At Tresle, we like to think, although it's not this simple in reality, we like to think of the sale as a straight line between A and B. A being that initial discovery phase, gathering information about a sale and that decision to sell, and B being the closing. So at some point, regardless of who the buyer is, and regardless of the process you're taking to sell, a buyer is going to come along and they're going to request, actually, I'll go as far to say that they're going to require a plethora of information. So in order to be productive, it's best to have this information, organized and readily available prior to even engaging. And no matter who you sell to, they're going to be required anyways. And no legitimate buyer is going to be able to put an intelligent offer on a business without kind of understanding the business as a whole, understanding kind of the value drivers of that. So having everything up front will drastically cut down kind of that busy work later on. So let's look at kind of a snapshot at what a minimum is required to have prepared. So this is also on, as you can see, it's listed on the slide. So think financial statements for the last 3 years, as well as year to date. List of any discretionary expenses in the last calendar year, 3 calendar years, excuse me, as well as year to date. Business tax returns, current debt schedule, accounts receivable, accounts payable, and a breakdown of your top 20 customers. It can be kept confidential. You can just write customer 1, customer 2, as well as the revenue that each one represents. And that's really for the buyer to kind of look at your customer concentration. So, this is a starting point, a kind of an opening volley. Preparing a company for sale goes far beyond financial statements. Having the company itself organize your operations is another crucial step. So this means, reviewing your articles of incorporation, licensing agreements, leases, permits, the company's legal condition, any client or vendor relationships, customer disputes, testimonials, employee contracts. Double check you have kind of all these points in order, up to date, and general hygiene. I think, and have it ready should it be requested by a prospective buyer. I think you'll be head and shoulders above the rest if you take that approach. Should I take my business to market to, quote, test the waters? So perhaps you have experience buying or selling a bigger ticket item before, maybe a house or a car, and think that it's similar to selling a business in the sense that you can remove it from the market, with very little consequence if you don't get your desired price. In other words, testing the waters. Very simply put, this should never be done when selling a business, and this can seriously damage the company's value, perhaps irrevocably. And let me explain why. So, to answer this question fundamentally, we have to understand what is being sold. Selling a business is not like selling a house. It's not like selling a car, in that a business is not a thing. You can't photograph a business. It's not a tangible item. Rather, a business is a system. A system where capital in the form of inventory, receivables, cash works together with machinery, people to deliver a solution to a customer. And in this system, you know, the team, the employees are the people involved in the system are doing their role to ensure the customer's problem gets solved. And as a result, hopefully, cash flow is generated for the owner. And since it's a system, it's open to risk of being unhinged. If any players in that system do anything wrong, it can directly kind of throw off that system and ultimately impact the cash flow. So in case of small businesses, this system is actually very fragile. Each player's role is magnified. So maybe there's 3 people in the sales division, not 3,000. There are 2 locations, not 500 locations. You get my point. So if things begin to kind of go sideways, it can materially mess up this fragile system. So the point is, when you decide to sell your business, you're going to trigger a sequence of events that are really hard to walk back from. You're going to try to keep the fact that you're selling confidential for as long as possible, but at some point, those people that are involved in the system, the employees, suppliers, customers, in other words, the people that rely on your business and that your business relies on, they're going to find out you're selling. And when they do, it will be disruptive to that system. They will become distracted. They'll wonder, how committed you are to the process. And as a result, it can ultimately have an effect on value. So when we're talking to prospective sellers, we want to always kind of take the impression of take as long as you want on the preparation stage. But when we're committing to going to market, we want to do so in an efficient manner and one that is not kind of testing the waters, if you will, and seeing what's out there without a direct plan of an exit. And I think that's the most successful way to go about it. How do I know if selling is the best exit plan for me and my business? Selling your business, is one of the hardest decisions entrepreneurs can make. Your company isn't just any job; it's ultimately something that you've built, and you've heard somebody say the expression "it's like my baby," and that's really, really common. So it's not surprising that business owners, don't want to contemplate selling or maybe push it to the back burner. But even if you don't plan on selling anytime soon, it's important to think about what an eventual exit will look like. The common denominator among all business owners, regardless of the size of their company, the industry, where they're located, their individual personality, everyone at some point will exit. So it's always better to go about it on your terms. So from a business perspective, it's quite simple. Sell when you're ahead. Waiting for the company to plateau or decline will ultimately not allow you to get that, desired premium on the market, that premium price. There's the expression that fortunes are made by selling too soon. So in other words, like we spoke about earlier, you never know what the future can hold. When things are good and the company's at its highest value, it's probably best to from a business perspective, operations perspective, to look at exiting. And like I said, from the business perspective, every advisor, will have their horror stories of clients who've held back for the big check and missed out, on an opportunity of a lifetime. So, like I said, that's the company perspective. Now let's look at the business owner, and this is where it becomes a little bit more nuanced. So sellers have their people, and people have ever-changing needs, desires, opportunities, options. So, as a seller contemplating a path to transition, it's crucial to understand kind of the landscape of your motivating factors. In our experience, we can kind of classify most exits fall under kind of the following six reasons. So, burnout, freedom of schedule, health and personal reasons, legacy, meaning sort of they're ready to kind of pass the torch on to somebody else, skill set, and risk tolerance. And what we mean by this is kind of, most of their net worth is tied up in the business and they want to kind of diversify a little bit. So notice how I didn't say, money. And this is because, most people don't realize this, but you'll almost always do better financially, assuming the company, continues to perform, by not selling your company. And this is true whether you're a business owner or an employee. Nobody retires for the expectation to make more money. People do it to have freedom of schedule because they're burnt out, because health and personal reasons, and the list goes on. So except for very rare scenarios, it's more profitable almost in every case to leverage your financial resources against your time, wisdom, and relationship within your sphere of expertise than it is to actually exit the business and sell. So, and the math, it sounds counterintuitive, but it's actually quite simple. So we've kind of broken down an example here. So imagine you own a stable, profitable business that's producing $1 million a year in owner earnings, essentially. So if you sell the business, let's say you agree to 4 multiples, so that's 4 million, and let's say that's broken up into 3.4 cash at close, and then a $600,000, which is 15%, seller note at a 5% interest rate for 5 years. So let's look at what that will yield after 5 years, and the answer is just over 4 million, so 4,080,289. And let's look at that same time frame if you were to, say, take an alternative route and maintain the ownership option. So let's say rather than selling, you hire a talented manager, you remove yourself from the day-to-day operations of the business, and the company continues to grow at, I don't know, 5% a year. So after that 5%, that 5-year time frame, the math actually works out to be, what you'll end up earning after that is, just over $5.8 million. So that's a huge difference. And of course, this is a really basic example. One has to consider taxes, opportunity costs, risk tolerance, and so more, and so on. But there's also a lot of further. There's also a lot of ways that this can go sideways. However, the point here is when you sell, your timeline becomes finite, and that ultimately, ends your ability to earn and your potential to earn. So when it comes to selling a business, I think it's really important to kind of do some self-reflection, like we talked about earlier, and really focus in. I'm not here to say that money doesn't matter, because it does, but we have to have another reason here. And I think from our experience, these kind of 6 target areas are very valid and are very common amongst the clients that we've served and kind of the deals that we've observed as well. What are contributors to value in a business? So valuations are always a tricky concept, but a valuation is a prognosis of future business expectations based off of historical results or yardsticks. So in order to accurately reflect, articulate, and defend these expectations, it's important to understand what drives value. And there are hundreds of value drivers. Some are very industry specific. But I think for the sake of this discussion, let's look at a few all-encompassing factors that we consider essential to increasing cash flow and reducing risk. And therefore, those are kind of the core things that we're looking at in terms of enhancing overall company value. So company risk, excuse me, company value, industry. This is a classification. So I think these are kind of the questions we need to ask. Like, how long has it business been in operation? How scalable is it? What barriers of entry exist within the industry? How has technology affected the company and its industry? How does the company's margins fit in terms of kind of the norm within the industry? Is the product or service proprietary? And then kind of moving down to competition, are there protections or moats put into place against excessive competition? What is the nature of the competition? Is it saturated? Is it fragmented? These are all questions to consider as well. Marketing, how strong the customer base is, how stable it is, how diversified is it? What can the marketing methods be automated or easily reproduced? Looking into the operation side, is the business located in a desirable location? Are the policies and procedures well documented? Do you have management in place to kind of take over and help shepherd the buyer into the future? And then looking at the finances, do your tax returns match your financial statements? Do you have unreported income? Are the revenues increasing, decreasing? Is there equipment that needs to be updated? Is there maintenance that's scheduled that has been deferred? Are the accounts receivables healthy and achievable to be received? And then lastly, I think the seller, how many hours per week is the seller working? Is it relatively turnkey? Are they willing to finance a portion of the purchase price? Are they willing to sign a non-compete? If so, for how long? And last but certainly not least, are they willing to stay on post-close and help with that transition? I think these are all importance across all industries in terms of contributors to value. My business has debt. Can I sell it? So this is a topic that is often overlooked. And the short answer is yes, a business with debt can be sold. However, it's how the debt is handled that's ultimately the important question at hand, and it largely depends on how the transaction is structured. So we've listed here kind of the two main structures of a sale: stock sale and asset sale. And I'm going to kind of talk you through how debt is handled in the case and as it relates to small businesses as well. So in a stock sale, the buyer takes over everything that the entity owns, including its assets and all liabilities. So for instance, if a business is sold as a stock sale and at closing the business owes money, the new owner would now be liable for that debt. So generally speaking, stock sales are only used for larger transactions, as it can be quite time consuming and tedious and costly to investigate and actually look at all the risks associated with each and every liability a company has. So since most small business buyers and sellers either don't have or can't justify the time and resources required to take this kind of forensic approach, most small business transactions are categorized as asset sales. So I'll talk about that next. So let's look at an asset sale. So contrary to a stock sale, an asset sale specifically targets certain assets and certain liabilities in a transaction to be agreed upon which ones will be transferred. And the combination of which ones are obviously subject to negotiation. And as you may surmise, asset sales really need a clear understanding between the buy side and the sell side in terms of which ones are being transferred. And there's a ton of different combinations out there. However, most transactions in the small to medium-sized business space take kind of the form of what's called a cash-free, debt-free basis. This simply means that when the buyer buys the company, they will assume materially all the assets, and will not take on any of the debt that the business has. Consequently, the seller is expected to pay off said debt obligations with the funds of the purchase. However, the seller, gets to keep any existing cash in the company, with typically with the not including the adjustment for any operating cash, which is kind of a minimum threshold amount that the company needs for running its operations day to day. But any excess cash would be kept by the seller. So cash-free and debt-free basis. So let's take a look at an example. So a buyer is looking at acquiring a company, and let's say they value the company at $1 million. So the company has, let's say, $200,000 in debt on its balance sheet, as well as $100,000 in cash on its balance sheet. So of that $100,000, let's assume that 10,000 of it is kind of essential operating cash or working capital to be included in the sale. So since the buyer is going to buy and pay $1 million for the value of the business, the seller will ultimately receive $1 million, but is expected to pay off $110,000 in net debt. So there's the $200,000 in debt offset by the excess cash of $90,000. And in the end, the seller walks away with $890,000. What taxes will I have to pay after I sell my business? So unless you've lost money, you can't really escape paying taxes on the proceeds of the sale. So the income generated is often classified as a capital gain, and it applies to whether you're selling the assets of a company or the shares of company stock. There are, as you'd imagine, many factors that go into calculating what comes due on tax day. So sellers should absolutely consult with a tax professional prior to selling their business and during the process. But we'll kind of highlight some key factors that play a role in how it can affect the taxes that are due. So the type of company, starting from the top, absolutely plays a role. So for example, if you own a C corp and you sell its capital assets for a profit, you'll ultimately be taxed 2 times on the sale, since corporations are considered separate entities from their owners. So the IRS requires each entity to pay their own share of taxes, and then you'll be taxed at a personal level as well. This isn't the case for S corps and LLCs. So being cognizant of that is important. We touched on this in the prior slide, but actually the type of structure. So if it's a stock sale or an asset sale, that can also play a role. So how the sale is structured. In a stock transaction, the buyer actually purchases stock in the ownership stake of the business, where an asset transaction involves the capital assets of the business. So and kind of on that note, purchase price allocation really matters. So I know that we have it as a separate point here, but capital assets can be classified in different ways by the IRS. So how the purchase price is allocated plays a role in everything. So next point is pretty obvious, location consideration. So as a small business owner, that taxation unfortunately doesn't end at the federal level. You'll most likely be liable for state or even local taxes. So being aware of kind of where you're situated plays a role. And I think another one kind of to mention is seller financing. So maybe there are folks out there that think that they're going to be paid 100% cash for the company, and ultimately that's not really the case. I would say that most transactions have some sort of seller financing, and we'll be touching a little bit more about what that is later on, but basically it's deferred payment uh, over time. So you'll be able to collect a portion of the sale price over time at a set interest rate, exactly like what it sounds like. It's essentially a loan that you're providing to the buyer, and ultimately you'll get paid over time, and therefore, ultimately it can kind of spread out your taxation. So something also to consider. And of course, like I said, we can't stress enough that obviously a local tax professional has a strong understanding of your industry and kind of personal situation can help you tremendously with this. Is inventory included in a sale? So this is probably one of the most, I guess, underrated topics, and I think a huge point of confusion for a lot of folks. But it's customary in most transactions to include a normal amount of inventory included in the purchase price. The way that you can kind of think of this is that just like any other tangible asset, whether it's machinery or equipment, they're included in the purchase price. The same should be true for inventory. These assets are required to generate the cash flow that the company is being valued at. So it has to be included in many cases. So if a buyer's required to replenish the inventory the day after closing, or purchase additional equipment after purchasing the business, this additional working capital requirement would need to be taken into consideration, and obviously that can affect value or ultimately the proceeds that you get from the sale. So how do we handle it specifically? So typically the seller just starts by estimating the average amount of inventory they use on a day-to-day basis, recognizing that it can fluctuate wildly. Seasonality is a huge example of this. And the business typically goes to market at a certain price, and that price is inclusive of inventory valued at whatever the seller estimates it at. So we'll pause here because you might think, wouldn't this be a great opportunity, assuming you have a, whether it's coming from a point of being dishonest or just, not knowing specifically, is there maybe an opportunity for a seller to kind of pad their inventory and saying, okay, well, for example, I'll give it a little extra $100,000 in value or something like that. But ultimately, an inventory count will take place right before closing, and the final price will be adjusted up or down based on the actual inventory at the time of the sale. So, for example, and we have this kind of laid out here. So let's assume that a company has a seasonal product. Let's say Christmas trees. So when in season, let's say the inventory level is 450,000. In the off season, let's say it's 100,000. But typically, let's say the owner kind of hovers around the $250,000 range. So in this case, the company would be taking to market at a certain price, and that price includes $250,000 of inventory. Then, simply put, if the business is sold at the height of the season, the price will be increased, possibly by something as close as 200,000, the difference between the amount included and the peak, to account for this kind of surge. So similarly, if the transition closes on the off season, the price will be reduced to reflect the actual inventory at hand at the date of closing, because the buyer will have to subsidize that difference. We'll have to pay that difference. So as you can see, there's kind of a check and balance system that dissuades maybe potentially dishonest sellers from kind of padding their inventory value, because they realize that the price adjustment is going to occur anyways. So there's not really a big point in kind of getting ahead and being kind of untruthful towards the buyer. So with that said, the guidelines and considerations for addressing inventory can be different depending on industry, business type, the amount of inventory involved when valuing a business. These are kind of rules of thumb But for certain businesses, the value of the inventory is very high in relation to the business. So an example of this would be like a car dealership or even a jewelry store. And it might be challenging for the buyer to cash flow the transaction if all the inventory was added to the purchase price. So a calculation for excess inventory may be warranted, where the normal amount is included in the multiple and an excess component is added to the purchase price. So it's included in addition. In cases where the levels are not commensurate with the ongoing operation of the business, it can also how the inventory is valued and dealt with can ultimately vary as well. But I think this is a fair kind of rule of thumb of most business products. What is seller financing? So at a high level, seller financing, also known as a seller note, is when the business's original owner offers the buyer of the business a loan to cover a portion of the price of the business. So first, the buyer makes a down payment in cash. Typically, next they access some sort of financing through a bank or financial institution, and the seller's note really covers the remaining amount of the sale price. So like any loan, however, it includes an interest rate and a repayment schedule according to agreed upon terms between the buyer and the seller. Seller note rarely covers the entire purchase price of the business, so buyers usually use some other form, like I said, of financing through a bank or financial institution in tandem with the seller loan to come up with the final purchase price. So here we've kind of outlined typical seller note or seller financing terms. So obviously every deal is unique in its structure. Nevertheless, kind of the good rule of thumb of most seller notes kind of look like this. So kind of the loan amount ranges anywhere from about 10 to 30% of the purchase price. The length of the term is about 5 to 7 years. Interest rates, they vary obviously as interest rates go up and down, but kind of need to be competitive with banks and other lenders for the buyer to even consider it. And the repayment rate is typically monthly or quarterly. So as a seller, I think being upfront about your willingness to participate in seller financing and have a rough idea of the basic terms you would like is a good start. So knowing and communicating this upfront will only attract more buyers. To be honest, most transactions have some form of seller financing or note. And it really acts as, a commitment, I guess, from the seller that saying, hey, look, I trust that the business is going to be good, and I'm willing to, put a little bit of skin in the game to ensure that the transaction's going to be successful for all sides. So I think having kind of your blueprint ready will kind of help lay out your expectations and so on for the selling process later on. How do I know if I found the right buyer? So just like buyers perform due diligence on you and your business, performing due diligence is equally as important for the seller to do to the buyer. So I think the first step here is to kind of understand what type of buyer you're dealing with. Individual buyer, financial buyer, strategic buyer. We have a content piece that's available for free to download, and we'll tag it in the show notes about this as well. But this is really important into kind of your search of finding that ideal buyer. Is that each one, though there's classifications, each one has different motivations, and therefore will look at your business differently and structure a deal differently. So one of the most time-consuming yet critical steps in the sale process is screening potential buyers. So a major mistake that most sellers make during the early phases of a transaction is wasting too much time and energy on buyers who are not qualified and getting too ahead of themselves when assessing interest, which I get it. It's an exciting time to get people interested in your business, get offers, or even frankly, just discussions. But doing so without obtaining like a background information on the buyer is very uh, dangerous, I guess. So don't do this. Before investing, your time, your precious time in negotiating with and getting down the line with prospective buyers, you first want to deeply understand, what their motivation is, as well as what is their capacity to close. Doing so will kind of help ensure the negotiations and discussions are being built towards a truly attainable common goal. Because the reality is that most buyers who aren't serious won't go through the troubles of a screening process. The true tire kickers aren't going to go through a tough screening process, and it's only fair. You're doing it for them. So uh, obviously you can kind of structure this process depending on who the buyer type is earlier. And like I said earlier, if it's an individual, maybe that's going to look a little different than if you're screening for a company buying your business. But part of your initial buyer due diligence is really to assess the buyer's motivation. So and kind of their background. So on the right here we have a little diagram that says like who, what, where, when, why, and how. So it's kind of understanding that 360 view of that buyer. So why are they interested in the business? What sorts of investments typically catch their attention and why? What is their ideal time frame? What does an ideal transition look like for them? How do they plan on financing? How far along are they with their financing? Have they purchased a business before? In asking these questions, also pick up on the softer cues. How motivated does this buyer appear? Do they return your calls and emails quickly? Are they eager to move forward? Or do they seem overly critical? These are all things that I think are worth considering. How long do I have to stay in the business after I sell? In most circumstances, the sellers will need to stay on post-close as a condition of the sale. And this time scale often differs and is dependent on, ultimately the final contractual terms. However, transitions can be as short as, under a month or two, as long as a year. We've also seen scenarios where the seller works at the business kind of indefinitely or stays on as an advisor long term. So, but in most situations, the buyer wants the seller to remain on board to really shorten that learning curve and retain key relationships that they've built with suppliers, customers. And like I said, occasionally there's owners who want to sell, but they're just not ready to quit working. They may be looking to sell early to get a premium price, or get away from kind of the unwanted or overwhelming management duties, but they still love the people they work with. In such instances, like I said, long-term contract is negotiated, and the seller can maintains daily involvement for a much longer period. However, for the owner that wants to sell the company and leave quickly, the focus, or relatively quickly, the focus should be on the development of a strong management team. This will only help facilitate this further. If managers are empowered to really take ownership of decisions and take on important duties, it decreases the business's reliance on the seller themselves, as well as the learning curve of new management. You've probably heard the term turnkey before, same sort of idea. So before committing or to staying or leaving, ask yourself kind of the following questions. Are you truly ready to move on? Are you still passionate about the company? How do you feel about someone else kind of changing the direction of the business? The period when ownership transfers to the buyer is often overlooked, but it can be a really important phase in the transaction. And ultimately, it's about creating a win-win for both sides. What will life look like immediately after the sale? So let me start by outlining kind of the obvious extremes as it relates to seller involvement post-close. So in the worst case scenario, the buyer can fail due to inadequate training, and the business can close down. This will result in kind of likely significant damages for both parties. On the other hand, the best case scenario is that the transition goes smoothly and the new owner is successful and everybody wins. So clearly, we all want the outcome number two that I just described. So let's touch on kind of some points on how to achieve this. So first off, communication is key. When in doubt, communicate. It's absolutely critical for the buyer and seller to openly discuss their expectations, so there's that no surprises down the roads. We've heard of stories in which the buyer actually bought the business, continued to work at their prior job after closing, expecting that the seller was going to continue operating the business. Well, that wasn't communicated. The seller actually thought that they were retiring. So this has obviously caused a massive amount of confusion, and it can be a big headache for everybody. So this would never have happened if it was very clearly communicated. So the questions to be that must be answered is, who will be running the business while in the transition process? What is a reasonable transition period given the nature of the business and the skill set and background of the buyer? Who is all involved in the training process? Will help exist beyond the training period? We typically see and suggest structuring this assistance as a consultant basis, and kind of be flexible around this, but it needs to be defined. So once the above is answered and everybody is in agreement, we suggest creating a training agenda. So it's on both sides to create this agenda together, as both sides will need to use it and know how it applies to their roles. So a well thought out list of any critical issues should be covered in the training period and will ultimately lead to a more effective and successful use of everybody's time. So we suggest putting in writing the following. So a list of all topics to include. So whether that's customer relationships, operations, accounting, bookkeeping, legal, employees. This includes hiring, onboarding, training, an agenda for procedures, tools, skills that the buyer needs to be trained in, a timeline for this process, as well as kind of timelines for each step of the process, a ranking system in terms of priority, how the training will be performed. Will this be in person? Will it be in writing? One thing that we've seen people do before is actually record in video a highly technical and detailed process so that they can be referenced later on. So the point is that the agenda should be as clear and defined as possible, meaning mark each item as it's complete. When it's finished, have both parties sign off on it. Keep it in a spreadsheet, attach any applicable how-to items to this agenda for your records. And it just makes everything crystal clear moving forward, so there's no hiccups in the transition period. Where can I get more information on how to sell my business? So deciding to sell your business is probably the second most important decision any business owner makes, only behind starting the business in the first place. And often there's not a lot of quality information around there, and if it is, it's really hard to find. So at Tresle, we have a wide range of blogs, interviews, downloadable contents, webinars, all aimed at making kind of selling your business in the private market a little less private. So whether you're looking to sell now or in a few years, any of these links you can access, and we'll provide them in the show notes below. We keep them fresh and keep updating them. So definitely want to help small to medium-sized business owners be educated in this process. What is Tresle? Founded in 2015, Tresle is a marketplace and platform that enables buyers and sellers of small to medium-sized businesses to transfer ownership. This means using technology to create enhanced personal connections, not replace them. So On the seller side, we have two solutions. We have a marketplace as well as a service called Tresle Plus. The marketplace is a self-serve platform where sellers can list their businesses for sale, reach the right audience, and seamlessly, manage their sale from start to finish. Thousands of small business owners trust the Trestle marketplace to manage their sale with confidence, and we are in almost every state across the country. With Trestle Plus, it's a service that we offer to select companies anywhere from about $2 million to $100 million in sale. We work with them and provide a little bit more of a hands-on approach. So we do this without, any massive upfront costs or long-term engagements. And essentially, they get a dedicated team that works alongside them from every step of the business selling process, from organizing the documents to valuation to designing a custom strategy to procuring a buyer or buyers, and ultimately working with them and any ancillary staff members to bring the company through a successful closing. Thank you, everybody who's tuned in to today's discussion. If you have any suggestions or questions regarding future topics, drop us a line at hello@tresle.com. Thank you and take care.